Next up, we're going to look at the deductions. The first deduction is OASDI. Now, figure 7.3 in your book will give us the OASDI rate. Right here, 6.2% on the first $147,000 of gross earnings paid to each worker in the calendar year. So in the spreadsheet, we can click on the Employee Earnings Records tab. There's a record for each employee. Bono is listed first. The cumulative earnings column, the year-to-date amount prior to this pay period is $10,293.40. During this pay period, Bono is earning $1,408. The cumulative earnings before this pay period plus the earnings for this pay period is below the threshold of $147,000. That means all of Bono's earnings will be subject to the OASDI tax. In the Payroll Register tab, we can scroll over to the taxable earnings for OASDI. We enter the total earnings of $1,408. Multiply the total earnings of $1,408 by a rate of 0.62 to arrive at the OASDI tax of $87.30. Remember to check each employee's cumulative earnings to be sure that no employee has exceeded the threshold. Looking back at figure 7.3, you can see the HI rate is 1.45%, and that is on all earnings that are subject to that tax. In the taxable earnings column for HI on the spreadsheet, we enter the total earnings of $1,408. Because there's no threshold for HI, the HI taxable earnings column will always be equal to total earnings. We multiply Bono's regular earnings of $1,408 by the rate of 0.0145 and arrive at an HI tax of $20.42. The next deduction column is FIT. This stands for federal income tax. Figure 7.3 says we're going to use the wage bracket method to calculate FIT. If we use Bono as our example, the payroll register tells us he is married. We know that employees are paid biweekly. You can turn to the wage bracket tax tables in the back of your book. The table for this one would be TT-7 for biweekly payroll. If you're using the ebook though, you may prefer to just go ahead and use a link to the 2022 publication 15T that's provided in the lesson folder for more clear viewing. Let me show you where that is. Back in chapter 17, you will find the link to that right here. I do have an image of what we would be looking at on that. You're going to look for biweekly. You're going to be looking for wage bracket method. Married filing jointly. You're going to look for Bono's pay, which was $1,408. So if I look at the amount over $1,390, at least at $1,390, but less than $1,410, I see that $40 is his federal income tax. So the tax is $40. The next deduction column is SIT or state income tax. In our ebook for state income tax, it says it's 3.07% withheld. So we're going to multiply Bono's total earnings of $1,408 by 0.0307. And the state income tax for him will be $43.23. The next deduction column is SUTA, or state unemployment taxes. Figure 7.3 says the employee rate is 0.0006. So we multiply Bono's total earnings of $1,408 by 0.006, and we get SUTA of 0.84. The next deduction column is CIT, or city income tax. Figure 7.3 says the rate is 0.38398. So we multiply Bono's total earnings of $14.08 by the rate of 0.38398 to get CIT of $54.06. Group insurance will only be deducted from the last paycheck of each month. So you won't be doing it in this one, but you will be doing it in the next month. The rate is 30 cents for each $1,000 of coverage. You can find the coverage for each employee in figure 7.2. And for example, Bono has $55,000 in life insurance. If we divide $55,000 by 1,000, we arrive at 55. If we multiply 55 by 0.3, we arrive at a deduction of $16.50. We're just going to go ahead and put this down here for when we come to it later. Those will only be the last paycheck of each month. It will not take place on the October 9th payday. The next deduction is going to be for union dues. The book tells us that Bono and Ryan are union members and the $8 will be deducted from each payday. The company will begin offering Simple on November 20th. Be sure to consider these contributions and how they're excluded from income for federal income tax purposes. Also note that you will not